on March the 23rd, we had a huge blow up, a fracture, a break between the paper market and the physical market. Now,
hello there, my friends. Chris Marcus here with you for Arcadia Economics. Hopefully you caught last night's episode with part 1 of the interview with Andrew Maguire. And if you enjoyed that, then you are darn going to love what he shared in part 2. And with that said, let's dig right in.
So really, it is about these 1,000-ounce bars and how many you can get, how many you're restricted to. And now we find the refiners, as of today, being restricted by UBS in particular to Arcadia, for example, today. So that's a good example of how tight things are.
Yeah, which makes me wonder if we're about to find out whether there really is any physical delivery component to the COMEX, because first of all, with that gold to silver ratio you mentioned, I get a lot of customers that are looking to buy gold and silver. The majority of them are buying silver. So it's one thing, I don't know, maybe I think the ratio should be this or that. But if people are buying 1-to-1 or even more dollar amount of silver, that in the end is what's going to matter. And you talked about the arbitrage that's on the board. And I know people, some are concerned, well, the premiums are high, although is that maybe a matter of perspective where maybe the price of silver is somewhere around $20 or $25. And if there's no, I mean, the COMEX price might as well be the Mickey Mouse or the Disneyland price if you can't actually get metal from there. And at some point, is that going to be tested? Or maybe that we're at that point where it's being tested now.
Yeah, and I think, yeah, and I think really, if we sort of talk about the gold market in particular, because we're talking silver is going to track gold in essentially. What we're seeing in gold, which is a far, far bigger market, and we track the silver footprints because it gives us so much better visibility into what exactly these same actors are doing under the radar. So essentially, and I'll say silver, but I'm really talking about gold as well. What's happening is because on March the 23rd, we had a huge blow up, a fracture, a break between the paper market and the physical market. Now, I know you've gone through, and I'm sure your viewers have gone through many explanations of that, and I'm sure they're all accurate, but essentially, what did it mean? It meant the paper market broke. It broke away from the physical market. It caught out primarily not the US-centric traders. It caught out the 10 times larger traders that are trading over-the-counter spot gold. And that is literally, you're talking about delivery. There is no deliveries in the COMEX. I mean, no wholesaler I know would go to an expensive route and a high friction way of getting gold or silver. It's ludicrous. Of course, it's a pure paper market, and deliveries are generally the shuffling of warrants from one side of the blue line of the center line to the other. And it's just a big shuffle. And yeah, there's some eligible stuff. We're not talking about eligible anyway, because eligible is nothing to do with gold. So essentially, we've got what blew up was the much larger European banks who are forced to take an over-the-counter position. And there's only one source of hedging, and that's the COMEX, or has been the COMEX. That broke, and the trust is gone. And I think, so what you're saying is if you now have an over-the-counter position, which can be asked for delivery, and that's what happened, was that massive amounts of T+2, 2-day delivery spot gold was purchased. And instead of these guys being able to shuffle them off, they were actually forced to actually deliver. And this was when we went into a huge decline into March the 23rd. So everyone and their brother wanted, thank you, I'll take that. I want physical delivery, and I want it in 2 days. And that is your requirement to provide that to me. And that's the worst thing you can do to a paper market trader, is demand delivery. So what do? Exit that position as quick as possible so that I'm not exposed to it. But there was no exit. There was $100 spread difference. The ETFs blew up. I mean, so these banks are still hurting, and I mean severely hurting. we are seeing, we know of one particular, and I'm sure this is common across the board, one particular manager of a very large European bank was told a few days after this blow up to sign a piece of paper that says personal liability to you or walk. Now, this is a trader that had been in place for what, 15 years or thereabouts, 15 years, and was a good employee of the bank. Now, I'm trying to give an indication of how scared to counterparty risk, these bullion banks that have been in business for many years, hundreds of years in some instances, are now so scared about being caught out because the hedging mechanism that they relied on is broken. And no one wants to provide liquidity into the over-the-counter market. So guess what? And that's exactly why we're seeing the likes of these insiders now flipping the coin and saying, you know what, the better price is actually the futures price. So let's buy spot and let's take the profit. So I think, so really, if that answers your question, I mean, we could go into a lot more detail, but I think essentially, I don't want to bore people, but essentially that really should answer the question.
I don't think you have to worry about boring anyone. I'm quite fascinated with everything you're saying. I also appreciate you mentioning that, because I've been telling my audience that I've heard that 2 market makers got blown out on March 24th, which I think first heard you and Craig talking about it. I've heard a couple others mention, so I appreciate you shedding some light on that. A few last quick ones before we let you run here.
And just one more, I guess, one more tiny point to that is I think really I didn't answer fully, was the fact that you're asking about, you know, where a fair price should be, perhaps, and I think that's what you're leading to. Well, if there is no way of hedging and you want to stay in business, suddenly there's a huge demand for a physical exchange, and this is the key. And this goes back to what you're saying. What is the price? Does it matter what the price is? Do I price silver at $25 or $30? Do I price gold at $2,200 or $2,500? I'm happy to do so if I have an absolute secure hedge that I know is physical with no counterparty risk. Therefore, there is a massive demand now for that service, for a physical exchange where these banks can come in. They don't care what the price is. They're just in the business of providing bullion, whatever that price is. So I can see the price revaluing quite quickly, because no longer is the COMEX it's too high a counterparty risk, adding spurious contracts where you've got loco London gold, loco London silver, even, forget it. I mean, no one believes in that. Upping position limits in gold from 3,000 to 6,000 lots. Every effort to increase open interest or paper market open interest, but nobody can trade it. What they don't understand is nobody wants that risk. So once you've got a physical exchange and you've got no counterparty risk, you have a fungible bar. Now it could be a silver bar of the correct hallmark, or it can be a gold bar, a 4/9 gold bar. A kilo bar is a kilo bar. It is exchangeable anywhere. It is fungible and exchangeable to any other global exchange like that without any counterparty risk. So therefore, there is such a massive demand for such a physical exchange or a network of physical exchanges. I guarantee there are several people now looking to fill that void. And I say goodbye to the COMEX once that happens.
Yeah, well, and I appreciate that you're one of them, and we'll get to that in a second, what you're doing with Kinesis. Although before that, I've heard you've mentioned before the FCA, which I guess is a financial watchdog agency in London there. I know you've been talking with Andrew Bailey. I mean, correct me if I'm not getting this right. It seems like you've been walking him through this day after day for months, and now he's the head of the Bank of England. So, I mean, I hear they're taking it more seriously than the Department of Justice appears to be. any update you can provide on that?
Yeah, no, I met with Andrew Bailey before he became a governor of the Bank of England. But yes, and this was after we had a member of Parliament read get this whole market manipulation, gold manipulation story read in Parliament, in the UK Parliament, which it was, to which they had to answer questions. Now, as I said, the amount, he showed me his email, the member of Parliament showed me his email after they found out that they're going to be put into the lottery to be read. And basically, when you put a bill in place to be read, it goes into a lottery. So you can't guarantee it's going to be read. It happened to get through. But the minute that he listed it, he had about 20 or 30. There was a list of calls from LBMA personnel saying to tell him to back off. And it's really interesting that he didn't. And I really hold him in high esteem for doing that. And I don't know, you've probably looked at him, but Jeremy Lafroy, he's no longer a member of Parliament, but he was at the time. Yeah, really good chap. And he knew the story of gold and silver. He also, in his family, had been in the coffee business in Tanzania and had a similar thing done. Paper, coffee, ruined the lives of many of the people that they used to look after, who'd been running that estate for multiple years, if not generations. Wanted, literally unemployed, and so he was very, very he understood how these kind of paper situations. But I think the biggest concern for Andrew Bailey and for the FCA and the Bank of England was the fact that this created a massive liability, potential liability, to roll downhill into the UK, because as much as when they answered it in Parliament, they said, no, it's a US thing. Then when we got their attention, and that's why they asked to meet with us, was we really pointed out that when you have a server here and a server here, and you've got banks that are located in both locations, you cannot isolate it to US. This had a massive implication on yet maybe still fines coming, and I would think so. But the DOJ coming downhill, there's no reason why there could not be massive multi-billion-dollar fines coming, translating all the way through across the Atlantic into these taxpayer-insured banks, including the JP Morgans of this world. So, and there are obviously others, but so definitely we did meet, we did talk, they were concerned, and it seems to have, and then we even got in touch with them after the CFTC would refuse to speak to me about this new contract, the new GC4 contract that was trading at something like a $25 premium to the directly exchangeable contract. And that's something that stopped and reduced to a couple of bucks. But that was after we got in touch with them. So yeah, I think something's happening. I think slowly, one by one, the levers for these guys to pull that lever to mess with paper gold. I think there's not enough liquidity. The liquidity is evaporating. More and more hedge funds are now when they buy GC or SLV, instead of buying GC or SI, the futures contract, they're buying an ETF. It's cheaper. It costs them less. There's less friction. Reduces open interest, and it's open interest that they're trying to pump back up again. And so really you've got multiple things happening here where people want physical, and as a US trader, you're really unable to deal with the over-the-counter markets. So you're forced into the casino. But your choice is in ETFs rather than buying the futures contracts, which are so heavily gamed. And this is one way of achieving what Bart Chilton originally talked to you and me about, and everyone, and went public over, was position concentration is starting to evaporate, and it's being done by a physical driver, which is what we always knew would happen one day.
Yeah, and again, you mentioned Bart Chilton. I'm actually going to be rebroadcasting that this week because I think I know some people have seen it, but what he said there was beyond wild, and it's nice. I'm sure we'll have a field day over the next year or so. It's keeping people posted, and hopefully some of that fine money can actually go back to the people who were actually victims of this crime rather than the U.S. Treasury. Although, well, we'll see how that works out. Andrew, before we wrap up, I know you're creating a solution to a lot of this colossal government mess with Kinesis. And especially since we live in a world where you do have to be careful about digital or paper forms of silver. If you could tell people what Kinesis is and also touch on the audit facilities and structures that are in place so that people know if they do get Kinesis, you know, there is the gold there. It's not being JP Morganed out to however many hundred people.
Yeah, and I think, as you say, I think it's important that you do understand that if you're going to invest, as we all know, if you're going to invest in gold or silver, you have to be absolutely certain that it is either in your possession, clunk together, put in a place that you feel is safe, or to the extent that you can insure it, or make sure that it is absolutely allocated. It's in your name, and it never sits on the balance sheet of any institution where it's held in their name. And I think as far as the allocated bullion exchange, I've known Tom Coughlin since 2011 when he first brought the first pieces of that together. And it was an exciting time because in 2011, allocated bullion exchange has been around now since 2011. And allocated bullion exchange is the electronic physical exchange. And it's an institutional exchange which runs and handles all of the gold for that transits through Kinesis. So it's not in the sense, Kinesis, it may be a new company, but ABX is not. And so the systems are so well proven. We've got audits that from ABX which translate into Kinesis, that proves that every single ounce is backed by physical gold or silver. Not a single ounce sits on the balance sheet of Kinesis or ABX. And really, this is why this timing of this gold-backed currency is so exciting. It's the paper market drivers are so leveraged, and they sit on less and less physical. And the one-to-one gold and silver-backed Kinesis monetary system simply now has the biggest tailwind behind it, and it's going to benefit us all. And so from a physical supply demand perspective alone, this upcoming massive shift from paper to physical gold and silver comes just as this monetary system is gaining power. And I mean, I'm so excited about it. And obviously I am involved. I'm a director, I'm an advisor, but I'm just one tiny part of a superstar team of people who understand the importance of gold and silver. So we've done, and I think if one was to go into some of the webinars, the recent webinars, for example, that talks about the integrations with governments, physical exchanges, government clearinghouses, and Sharia compliance. NU, for example, is one of the companies that is actually has endorsed us. 100 million members with $7 billion of assets. I mean, we're just talking about a few here, but this is definitely this is not just an institutional solution. It is your solution. It's everyone's solution. It brings gold and silver back into the monetary system. And in other words, look, I want people to go on the Kinesis website, download the app, have a look. Kinesis, what it is a parallel monetary system, and it's just backed by fully allocated gold and silver. So I think I couldn't ask more than people just have a look. Costs nothing to have a look, and come and join us. Become part of this solution.
Yeah, and we will have the link to that in the description field below, right there, right somewhere down there. And I have a little surprise for you before we wrap up. Fortunately, our good friend Gavin Coates has been helping the technically challenged like myself but we are getting it set up so if people would like to purchase the big silver short, soon they will be able to do so with Kinesis money. So honored to be a part of what you're doing, and hopefully that'll let a few more people be aware. And again, I like that you have laid out all of the questions that I have. So by all means, people, go and do your own research so you can feel comfortable for yourself is really the best way to approach anything. And Andrew, I know you have a team of folks there that do respond to questions. So actually, before we log off, I will show in the bottom there is a chat button there. So you can talk with someone and find out what you need to know. And Andrew, with that said, sure appreciate you making some time. It's a pleasure to catch up with you as always. I sincerely thank you for what you've done and what you stand for, and excited to help in any way I can. And we will look forward to doing this again soon.
Oh, we will, and we will, absolutely. And as I say, a great deal of respect for you, Chris, and for what you're achieving here is also, it's epic. I think a lot of people have no, we tend to be so close to what's going on in the markets, and yet there are so many people that look at this from the outside and need to know what you've written does expose so much. It provides the bigger picture, and people can suddenly make their own minds up. And you're presenting evidence, and it's not, you get industry apologists out there saying one thing and another. Well, who do you believe? Well, get on go onto your big silver short and listen to Bart Chilton, listen to some of the regulators, look at some of the stories you tell. They're absolutely anchored in fact, and then let people make up their own mind.
Well, I sure appreciate that. It's going to be a lot of fun. I feel blessed to be a part of this, where it's one of those things I think people have felt for years. Well, what can we actually do? And you've been a leader for that. And we'll look forward to catching up with you again soon. Exciting things happening. Thank you again so much, Andrew.
Thanks, Chris. Thank you.